Welcome back to the deep dive. Sometimes reality feels stranger than fiction, especially when you think about quantum computing.
Uh,
There's this genuine threat that it could just break all our current digital encryption, everything.
yeah, it's a pretty scary thought, actually, of a potential cryptographic apocalypse, as you put it.
Exactly. So today, we're diving deep into a company that might just be part of the solution. A small, Swiss-based firm called SEALSQ Corp. Ticker is LAES.
Right, LES. And our job today is really to do some solid due diligence. We want to understand if this company, SEALSQ, truly holds the key to that secure digital future and, what that key might actually be worth.
We're basing everything on the data from October 20th, 2025. That day, the stock closed at $6.67 a share.
Got it. All analysis anchored to that date.
Okay, so here's the puzzle, the real head-scratcher for you listening.
Uh-huh.
This company, LAES, it has this incredibly compelling story, right? Focused on the future. Analysts love it. It's got a unanimous strong buy rating.
It does. But, and this is the big but, those same analysts, when you look at their average price targets for the next year, they're actually lower than where the stock is trading right now.
Lower. How much lower?
They're clustering around, say, $6 to $6.12. The market's paying $6.67, but the analysts doing the detailed forecast are saying, well, maybe closer to $6.
So the market's way more optimistic than the short-term analyst models can justify. That's the core tension we need to explore. Why is there such a disconnect?
Exactly. We're going to unpack why the market is so polarized on this one and what's driving that premium valuation.
All right, let's get into the nuts and bolts. So first off, what is SEALSQ? Their basic model.
Okay, so they're a fabless semiconductor company.
Fabless, meaning they don't own the giant, super expensive factories, the fabs, that actually make the chips.
Precisely. They focus their energy and capital on the brainy stuff, research and development, creating intellectual property. That's where the high margins are. The actual manufacturing, the capital-heavy part, they outsource that.
Makes sense. Keeps them nimble. How do they make money then?
They've got three main ways. Pretty diversified, actually. First is straightforward semiconductor sales, selling the actual hardware.
Like their established secure chips.
Right, they're Voltus microcontrollers, but more importantly now, they're next-gen post-quantum cryptography chips. The PQC stuff, that's the future focus.
Okay, stream one, hardware sales. What's next?
Second is software and IP licensing. This is really high-margin revenue. They license out their proprietary firmware that runs inside the chips and other IP. Think recurring, scalable income.
Nice. And a third?
The third one is managed services. This is key for customer stickiness. They offer public key infrastructure, PKI, and provisioning services.
PKI? That's like a digital passport system for connected devices, right?
Exactly. Imagine managing the digital identities for potentially billions of devices. Once a company builds SEALSQ's PKI system into their products, switching to someone else becomes incredibly difficult and expensive. That creates really high switching costs.
Okay, so that's the business model. What about their tech advantage, their moat?
Well, on the hardware side, the big headline is their Quantum Shield QS701. They announced it as the first secure chip that actually embeds the new NIST-standardized PQC algorithms right into the silicon itself.
So not just software, but baked into the hardware.
Baked right in. That's a big deal for performance and security. Plus, since they acquired IC Alps, they can design custom chips, ASICs, for specific customer needs.
And it's not just the tech specs, right?
Yeah.
It's about scale and trust.
Absolutely. They've already shipped secure chips for over 1.6 billion devices worldwide. Think about that number, 1.6 billion. That kind of track record builds enormous trust, especially in security-sensitive industries.
You mentioned barriers to entry earlier. What stops a big competitor from just copying them?
The certifications, this is huge. They hold these elite, really tough-to-get security certifications. Common criteria EAL5 Plus and FIPS 143.
Okay, those sound impressive, but what do EL5 Plus and FIPS 143 actually mean for an investor? Why should we care about that alphabet soup?
You should care because they represent time and money barriers. Getting EAL5 plus O, for example, isn't just about having a secure product. The process of testing and verification is incredibly rigorous. It can take years, literally years, and cost tens of millions of dollars.
Wow, okay.
And these specific certifications are often absolute must-haves for high-security government contracts, defense, critical infrastructure, markets where you can't just show up with a new chip and expect to play. It effectively locks out newcomers.
So they seem perfectly positioned for where the market is heading.
Absolutely. They're sitting at the crossroads of three massive trends. You've got the overall semiconductor market projected to hit $1 trillion by 2030.
Huge.
Then there's IoT security growing like crazy, over 33% a year, expected to be like $37 billion by 2030.
It's also huge.
And the biggest driver for them, post-quantum cryptography. That market is forecast to grow at a staggering 46.2% CAGR, hitting almost $3 billion by 2030.
And governments are pushing this, right? It's
Yeah.
not just companies wanting better security.
Correct. Regulation is a massive tailwind here. NIST finalizing its PQC standards, the EU's Cyber Resilience Act. These are making security by design a legal necessity, not just a nice-to-have feature.
So eSkill offers a way for companies to actually comply with these new rules.
Exactly. They provide this vertically integrated trust ecosystem, the chip, the digital identity management, the lifecycle support. It simplifies what is otherwise a massive, complex, and legally mandated transition for their customers.
Okay, the tech looks solid, the market tailwinds are strong, but who's steering the ship? Let's talk leadership. CEO Carlos Moreira. His background seems different for a semiconductor CEO.
It is quite unique. He spent 17 years, from 83 to 98, as a UN expert focusing specifically on e-security and trust models, working with global bodies like the World Bank.
So less chip design, more global policy and trust frameworks.
Right. That gives him a really valuable perspective on the global regulatory landscape, the geopolitical factors, things that are becoming increasingly critical in the semiconductor world, but which many traditional tech execs might overlook. He also founded the parent company, WISeKey, so he's deeply invested in this vision.
And that vision seems to involve spending a lot of money right now. Their strategy looks very aggressive.
Oh, absolutely. The clear theme is speed over near-term profit. They're going all in on capturing market leadership in PQC.
How does that show up in the numbers?
Look at R&D. It's climbing steeply. They've budgeted $7.2 million for R&D in fiscal year 2025. That's up significantly from $5 million the year before.
And they're investing outside the company too.
Yes, they have a $35 million quantum investment fund they're using to take stakes in promising quantum tech startups. Plus, they're spending capital on global expansion, these sovereign semiconductor joint ventures like the one in Spain, with plans for the US and India.
That all sounds expensive. Where's the money coming from?
Ah, well, that's the catch. This aggressive growth is being funded primarily through highly dilutive equity offerings.
Meaning they're issuing lots of new shares.
Lots of new shares, which, of course, dilutes the ownership stake of existing shareholders.
And what does that do to their efficiency? Things like return on invested capital.
It hammers it. Their ROIC is deeply negative. We're talking reported figures somewhere between -24% and -42.4%. It's a significant cash burn.
So as an investor, why tolerate that kind of cash burn and dilution? It sounds risky.
You tolerate it if you believe in the long-term prize. The bet is that by spending heavily now, they secure a dominant, maybe even unassailable position in the multi-billion-dollar PQC market before the big incumbents fully pivot or new competitors can catch up with those certifications.
Well, it's a land grab strategy. Buy future market share by selling present equity.
That's a good way to put it, yeah. High risk, potentially very high reward, but the execution needs to be flawless.
Okay, let's get into the specific financials. Market cap is around $1.1 billion, so still small cap territory.
Right. And the recent revenue trend tells a really interesting story. It grew steadily, hitting $30 million in 2023. But then, in 2024, it dropped sharply to $11 million.
That sounds alarming. Why the big drop?
Management says it was deliberate, a strategic pivot. They consciously decided to move away from some older, lower-margin legacy products to pour all their resources into the PQC opportunity.
A calculated risk, then. Short-term pain for long-term gain.
That's the narrative, and they are forecasting a strong rebound. For fiscal year 2025, they're guiding for revenue between $17.5 million and $20.0 million. That's roughly 70% growth year over year if they hit it.
What about margins?
Gross margin is actually pretty healthy for a fabless company, around 34%. But as we discussed, because of that heavy spending on R&D and also sales, general, and admin, their operating and net margins are deep in the red.
How deep?
Operating margins have been reported as low as negative 156%. So yes, definitely confirms they're burning cash significantly to fuel that growth.
But you mentioned a counterpoint earlier.
Yeah.
The balance sheet.
Yes, and this is crucial. Despite the cash burn from operations, their balance sheet is exceptionally strong, like fortress strong.
How so?
They have zero bank debt. Their debt-to-equity ratio is tiny, just 0.1, and their current ratio is 6.0x.
6 times. So $6 in short-term assets for every $1 in short-term liabilities.
Exactly. It means they have a very substantial cash runway. They can sustain this high burn rate for quite some time without facing an immediate liquidity crisis. That cash gives them strategic flexibility.
Okay, so strong balance sheet, but negative operating margins, which brings us back to that valuation puzzle, the price-to-sales ratio.
Right. On a trailing 12-month basis, the PS ratio is over 100x.
100 times revenue. How does that compare to the industry?
It's extreme. The average PS for the U.S. semiconductor industry is around 4.1x. So SEALSQ is trading at a massive, massive premium.
So that 100x PS isn't really reflecting current reality at all.
Not even close. It's purely a statement of belief from the market. Investors are pricing in enormous success, huge revenue growth, and significant profitability, but years down the line, maybe 5, 6, 7 years out. It's a bet on the future, not a reflection of today.
Which means we need to try and figure out what it could be worth intrinsically, right? Using something like a discounted cash flow model.
Exactly. A DCF model tries to estimate the value of all those expected future cash flows, discounted back to their present value. It's tricky here because those significant positive cash flows are quite far in the future.
So you have to make some big assumptions.
You do. We modeled multi-stage growth, starting with their publicly stated $170 million business pipeline for the years 2026 to 2028. And because of the high execution risk, the land grab strategy, the need for flawless execution, we have to use a high discount rate.
The WACC, weighted average cost of capital.
Right. We used a WACC in the range of 12% to 15%, which is quite high, reflecting that risk.
And what did that DCF analysis suggest for the intrinsic value per share?
It yielded an estimated range of $4.50 to $7.50 per share.
Okay, $4.50 to $7.50.
Yeah.
And the stock is currently trading at $6.67.
Right. So the current market price is sitting squarely in the upper half of our estimated intrinsic value range. It confirms the market is already pricing in a very optimistic scenario, giving them maximum credit for future success.
Makes sense.
Okay.
Before we shift gears to market dynamics, just a quick reminder. If you're finding this deep dive helpful, please do hit that like button and subscribe to Stock Analytics AI. It really helps us out. Okay, we've got the fundamentals, the financials, the valuation paradox. Now let's look at how the market is actually behaving. Who's buying, who's selling, who's betting against it?
Well, technically speaking, the stock has shown really strong momentum. It's trading significantly above its key moving averages, the 50-day and the 200-day simple moving averages. That usually indicates positive sentiment among traders.
And the news flow has been good?
Overwhelmingly positive, really. Lots of buzz around the QS7001 ship launch, that successful $200 million financing round we mentioned. The headlines look great.
But we know there's skepticism because of that valuation. How does that show up? Is anyone actively betting against the stock?
Oh, yes. The bear case is definitely present and focused squarely on that high valuation and the ongoing cash burn. Short interest is notably high.
How high?
It's 12.84% of the company's float. That means a significant chunk of the shares available for trading are being borrowed and sold short by investors, betting that the price will go down.
So more than 1 in every 10 shares available is betting against the company.
Essentially, yes. It tells you there's significant institutional capital out there that believes the stock is fundamentally overvalued based on its current financial metrics. It really is a battleground stock, bulls betting on the future, bears focused on the present. So who actually owns the stock? Let's look at the ownership structure.
Is it mainly retail investors or are institutions getting involved?
Institutional ownership is still relatively low, somewhere in the range of 4.7% to 7%. But the key trend here is the direction. It's growing rapidly.
How rapid?
We saw a 167% increase quarter over quarter in the number of institutions reporting ownership. So professional money managers are definitely starting to pay attention and build positions. The smart money is waking up to the story.
And didn't that big financing round bring in a major new player?
It did. A firm called CVI Investments, Inc. came in through that $200 million financing, and they now hold a very concentrated 9.9% stake in the company.
Nearly 10%. That's a significant chunk for one investor.
It is, and it acts as a strong vote of confidence. Having a sophisticated investor like CVI take such a large, concentrated position signals belief in management's long-term strategy, despite the near-term metrics.
What about insiders, like the parent company, WiseKey?
Their ownership has actually been significantly diluted because of all those equity offerings needed to raise capital. WiseKey's stake is now down below 5%. They've had to let their ownership percentage shrink to fund the growth.
Right, let's pull together the risks. Internal strengths and weaknesses first.
Okay, key strengths are pretty clear. They're a first mover in PQC hardware leadership. They have a solid patent portfolio with over 130 patents and, as we discussed, that fortress balance sheet. They've got roughly $400 million in pro forma cash after the recent financing and no bank debt. That gives them years of operational runway.
And the weaknesses.
Also clear, unproven profitability, they're still burning significant cash. High execution risk trying to build this global PQC ecosystem is incredibly complex, lots can go wrong. And the history of significant shareholder dilution to fund that growth is a persistent concern.
Okay, those are internal factors. What about external threats? Things outside their control.
Competition is obviously one. They're up against massive, well-funded incumbents like NXP Semiconductors and others who won't cede the PQC market easily. But the most specific and potentially highest impact threat right now is geopolitical.
You mentioned tariffs earlier.
Exactly. This is the big one hanging over their U.S. operations. Back in 2025, the U.S. imposed broad tariffs on imports from Switzerland, some as high as 39%.
Ouch. How does that affect SEALSQ?
Currently, they are protected. There's a specific, but importantly temporary, exemption for semiconductors and related devices within those tariffs.
Temporary. So their ability to compete on price in the U.S., their biggest potential market, relies entirely on a political decision that could change.
Precisely. It's a precarious situation. If that exemption were revoked or even just narrowed, it could be catastrophic for their U.S. business. It would either make their products suddenly much more expensive than competitors, or it would completely crush their gross margins if they tried to absorb the cost.
That sounds like a massive vulnerability. Is management doing anything about it?
They are. This is why their strategy of building regional sovereign semiconductor joint ventures like the one in Spain and the planned centers in the US and India is so important. It's a direct hedge against this kind of trade friction and territorialism. By localizing some production and presence, they aim to mitigate that political risk exposure.
Makes sense. Any other major external risks?
The main one is macroeconomic, specifically interest rates. Because so much of SEALSQ's perceived value is tied to this distant future cash flows, the valuation is highly sensitive to the discount rate, the WACC.
So interest rates go up.
If interest rates rise significantly, the WACC goes up, and the present value of those future profits shrinks automatically. That can put downward pressure on the stock price, even if the company itself is executing well. It's a valuation risk inherent in long-duration growth stocks.
Okay, let's bring it all together. We've covered a lot of ground. How do we synthesize this? The bull case versus the bear case.
The bull case really rests on three pillars. One, their strategic first-mover advantage in PQC hardware, backed by those tough certifications. Two, the massive market tailwinds from regulation and the quantum threat. And three, that fortress balance sheet, providing the cash runway to pursue the strategy.
And the bear case.
The bear case is equally stark. One, that extreme valuation, the 100x PS ratio, just screams priced for perfection. Two, the high risk of continued shareholder dilution needed to fund the cash burn. And three, the simple fact that profitability is still unproven and potentially years away, requiring flawless execution.
So going back to our valuation work, that $4.50 to $7.50 intrinsic value range, where does the current $6.67 price leave us?
It leaves us right where the polarization suggests. The current price is firmly in the upper end of that estimated range. It clearly reflects the market's highly optimistic view, fully baking in successful execution and market capture 5, maybe 7 years from now. It's not pricing the company based on today's reality.
So what's the final takeaway for you, the listener, considering this stock?
The takeaway is that LAES is currently priced for a near-perfect future outcome. The risk-reward profile might look balanced on paper if you believe strongly in that outcome, but it's absolutely crucial to understand this is not a stock for conservative investors or those with a short time horizon.
This is only suitable for?
This is suitable only for high-risk, tolerant investors with a very long-term perspective. Think 5 years plus, who have deep conviction that management can navigate the enormous technical challenges, the financial pressures, and critically, those geopolitical risks without making any major missteps. It requires belief in near-flawless execution.
That puts the decision squarely in perspective, which leads to a final thought for everyone to consider. Given how critical this PQC transition is for national security, for global infrastructure, and given the obvious geopolitical hedging SEALSQ is undertaking, how much longer can policymakers, especially in the U.S., really afford to keep that crucial semiconductor tariff exemption classified as merely temporary?
That's a very powerful question indeed, something to watch closely. And on that note, we really encourage you again to like this video and subscribe to Stock Analytics AI.
Absolutely. Remember, becoming a member for just $4.99 a Volnet gets you our entire library. That's 500 deep dive videos covering every single stock in the S&P 500. And coming up next, exclusively for members, we're tackling the NASDAQ 100.
Plus, members can request deep dives on specific stocks. If there's a ticker you want us to analyze, just drop it in the comments section and we'll get on it for you.
One last important point. Please remember that this analysis was generated by an AI system.
It's intended for educational and informational purposes only and should definitely not be taken as financial advice.
You absolutely must consult with a qualified, independent financial advisor before making any investment decisions.